RCI Hospitality Holdings, the largest adult entertainment company, has shown decent performance in 2023 so far. The company's revenue increased by 10%, indicating a positive uptrend in sales, but their net income decreased by 35% compared to Q3 last year. With this financial performance, the stock is down by 34% year to date, currently trading at a 52-week low. Today, we will be taking a 3-step approach to thoroughly evaluate RCI and determine its fair value. Step 1. Margin of safety. In this step, we'll look at RCI's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into RCI's financial statement and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as discounted cash flow and discounted dividend to gain insight into the value of RCI's business. By using these models, we can determine whether the stock is currently overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of RCI Hospitality as an investment opportunity. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. And we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using the scale. When we are using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. First metrics that we'll be looking at are the margin and EBIT growth. EBIT has gone up over the years, come from $23 million in 2013 to $72 million in 2022. The average EBIT growth during this period is sitting at 36%, which is way past the bright green part of our scale, indicating a 10% deduction in a margin of safety. The margin has also gone up over the years, come from just under 22% in 2013 to over 28% in 2022. The average margin growth during this period has been sitting at 14%, which is once again way past the green part of our scale, in this case, awarding them with a 5% deduction from a margin of safety. The next metrics that we'll be looking at are the dividend growth and the payout ratio. The dividends have gone up nicely over the years, going from 36 cents a share in 2016 to 88 cents a share in 2023. The average dividend growth during this period has been sitting at 14%, which is in the bright green part of our scale, indicating another 10% deduction in the margin of safety. This dividend is supported by a payout ratio that is currently sitting at only 6%, which is once again in the green part of a scale, awarding them with a 5% deduction on this metric, because they still have a lot of room left to increase their dividends further. And the final metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For RCI, this is sitting at just under 2.5 years, in this case a 241% debt to EBITDA ratio, which is just under the red part of our scale, meaning no change in the margin of safety on this metric. The return on invested capital for RCI is sitting at a very solid 9.8%, which once again falls in the orange part of our scale, which is no change in the margin of safety, even though the management is relatively effective at allocating capital. Looking very good so far for RCI. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of RCI going from 2019 to 2022. The average growth rate in their annual free cash flow during this period has been sitting at over 68%, and are projecting all of their future free cash flows to grow by 8% annually for the next 10 years. With this percentage, we'll determine the future free cash flow for RCI and determine a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 9%. This leaves us with a sum of free cash flow of just under $1.2 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of just under $1 billion, and dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $103.75, which is an upside of over 72%. The second model we'll be using is the dividend discount model. I've imported the dividend payments from RCI going from 2019 to 2023. The average growth rate in their annual dividend payments during this period has been sitting at over 14%, and I'm projecting all of their future dividends to grow by 7%. I will once again be using the discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $62.77, which is an upside of just over 4%. The next model that we'll be using is Graham's revised valuation formula. This model, we took a look at the earnings per share that RCI is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds that is always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value out of this model of $103.76, which is an upside of once again over 72%. The fourth model that we'll be using is the multiple valuation. This model, we take a look at similar companies to RCI, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 16.39. All that's left to do to get our intrinsic value out of this model is to then multiply by the earnings per share that RCI is generating, which is $4.07 a share, giving us a price per share of this model of $66.70, which is an upside of almost 11% from the current price. And the last model that we'll be using is the mean reversion theory. In the mean reversion theory, we go by the theory that a company will always trade above or below its mean. And the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of RCI for the past 5 years. And on average, it has been sitting at 0.49%, while the current dividend yield stands at 0.4%, indicating that it's slightly overvalued in this metric. Doing the same with the PE ratio, on average it has been sitting at 14.5, while the current PE ratio is sitting at 14.81, indicating that it's trading relatively close to fair value on this metric. And this gives us a price per share out of this model of $54.09, which is a downside of just over 10%. Let's go look at the final overview of our valuation next. Looking at the final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, multiple valuation, and the mean reversion theory price per share, giving us an average price per share of $78.21. On margin of safety, we've determined earlier using a standard margin of safety of 25%, deducting it by 10% for the EBIT growth and the dividend growth, and 5% for the margin growth, and 5% for the payout ratio, leaving us with no margin of safety at all. This means the fair value out of our models is the fair value that we have determined, which is $78.21 again. And with the current price then of $60.24, we get an upside of just under 30%, indicating a buy rating out of our valuation. If you want to get access to the valuation model I used in this video and much more other spreadsheets, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.